All right, let's just jump right into it. Today, we're doing a bit of a financial detective case study. We're diving into a brand new explainer covering the FY 2026 earnings report from the luxury watch retailer The Hourglass. And honestly, it is a total masterclass in capital allocation. We've got a really brilliant paradox to unravel today. A company posting record-breaking profits, but then making a completely unexpected move when it comes to rewarding its shareholders. So let's look past the headlines and figure out what's really going on.
Now, at first glance, wow, the Hourglass had an absolutely phenomenal year. We're talking revenue up a very healthy 15% year over year, hitting $1.34 billion. But I bet your eyes are drawn straight to that profit after taxation line. I mean, net profit literally surged by an explosive 32% to reach $179.4 million, and earnings per share jumped right along with it. If you're an investor reading this press release, your heart rate is definitely going up. You're naturally anticipating a massive reward for holding the stock.
But then you scroll down to the bottom of the report and bam, you hit a brick wall. Wait, what? Despite this massive 32% surge in profit, the board of directors recommended the exact same final dividend of 4.0 Singapore cents per share. No increase, just a totally flat payout. And this right here is the central paradox of our case study today. It's like, how does a company grow its net profit by almost a third overnight, but then decide to keep its shareholder payout completely frozen? Was it a mistake? Are they just hoarding cash? Let's figure out how that profit was actually generated.
Well, the crucial step here is separating the headline noise from the core reality. Actually, scratch that. It's more like separating paper money from real cash. That 32% profit jump, it's heavily distorted. The company recorded a $20.3 million fair value paper gain on their investment properties, which was a huge swing from the loss they took the year prior. Sure, it looks amazing on a spreadsheet, but a paper gain on real estate isn't exactly cash in the bank that you can just hand out to shareholders, right? You can't pay a dividend with bricks. Once we strip away that real estate volatility, the core operational net profit actually grew between 14% and 15%. Make no mistake, that is still an incredibly strong growth rate. It's just not the 32% cash windfall the headlines implied.
And the data brilliantly illustrates that operational strength. If we track back over the past 5 years, the revenue shows this relentless, unbroken staircase of growth. It really proves that FY 2026 wasn't just some post-pandemic fluke. The core business of selling ultra-high-end timepieces is remarkably resilient. Even when you pull out those real estate gains we just talked about, the core net profit shows steady, super reliable expansion year after year.
What's crazy is that this operational strength is especially fascinating when you view it against the broader market. Right now, the global luxury market is definitely cooling down. We're seeing weaker retail competitors literally panicking, slashing prices just to move aging inventory. And when you do that, your margins absolutely collapse. But the Hourglass, they've built an elite, fortress-like moat. Thanks to premier brand partnerships like Rolex and Patek Philippe, and the sheer physical scarcity of these products, they are maintaining a highly stable gross profit margin right around 30%. They simply don't have to discount.
So the operational cash flow is absolutely there, and it's growing at 15%. Plus, the business is heavily protected by those margins. But this brings us right back to our original paradox. If you have all this cash rolling in and a fortress of a business, why on earth would you freeze the dividend? I want you to step into the shoes of a business strategist for a second. If you were the CEO and you decided not to hand that cash back to shareholders today, where would you deploy over 70% of your operating cash flow to secure even more value for tomorrow?
Okay, here's the solution to our mystery. Management looked at the landscape and basically prioritized 3 massive strategic reinvestments over short-term dividend bumps. Number 1, they dropped $75.3 million to acquire a network of 4 Australian Rolex boutiques, which incredibly are already boosting the bottom line after just 10 months. Number 2, they spent $35.4 million converting prime real estate they already owned in Hong Kong and Auckland into active storefronts. And number 3, absolute debt clearance. They executed a net repayment of $56.7 million in outstanding loans, completely wiping the slate clean. Now, those were seriously aggressive moves. In fact, when you combine these investments with their usual lease liabilities and share buybacks, they actually had to dip slightly into their cash reserves to fund the whole shebang. But listen to this number. Even after entirely paying off their debt and building this massive structural foundation across the Asia-Pacific region, the Hourglass wrapped up the year sitting on a colossal $157.5 million cash cushion. Think about that. They funded a massive expansion, achieved a zero debt balance sheet, and still kept a 9-figure safety net in the bank.
Because they funneled so much capital into those 3 strategic pillars, well, something mathematically had to give. As earnings per share jumped to almost 28 cents, The decision to keep the total dividend flat at 6 cents caused their payout ratio to drop pretty sharply, down to 21.6%. Historically, they've anchored that payout ratio somewhere in the low to mid 30% range. So the dividend didn't stay flat because the business is struggling. It stayed flat because management was busy aggressively buying the future of the company.
And honestly, that is exactly why, if you're analyzing this business as an investor, you should be thrilled. They essentially took their massive $120 to $150 million capital expenditure budget for the next few years and just front-loaded it entirely into FY 2026. Going forward, the catalysts for free cash flow expansion are huge. Next year, they'll get a full 12 months of revenue from Australia. They literally have zero debt left to service, meaning those interest expenses just vanish. And with all that front-loaded spending, future CapEx drops. All of that extra cash has to go somewhere, right? It sets the stage for a very likely and very massive expansion in future dividends.
And this perfectly aligns with how management views the landscape. They noted that the specialist watch sector is undergoing what they call a profound structural reset. In an era where information is literally everywhere but genuine expertise is scarce, the winners over the next decade are going to be the companies with authentic partnerships and super resilient balance sheets. By pausing the dividend growth this year to clear debt and buy prime assets, they have engineered exactly what they need, the ultimate resilient balance sheet to dominate the coming decade.
It really highlights the unique nature of this whole industry. High-end horology remains unapologetically human-centric. In a world where basically everything is digitized and algorithms dictate how we shop online, you still cannot just click a button and buy an ultra-rare independent timepiece or an allocated Patek Philippe as some direct-to-consumer app. No way. It relies entirely on heritage, physical scarcity, and deeply trusted face-to-face local relationships. Investing here is part science, the math we just looked at, and part art, trusting management to recognize the unmeasurable appreciation of these values over time.
So we started today with a paradox, right? Record profits but a flat dividend. What initially looked like a huge disappointment on the surface was actually a total masterclass in long-term capital allocation. The hourglass traded a quick, flashy payout for an expanded footprint and total financial freedom. It definitely challenges how we look at earnings reports, and it leaves us with this final thought to ponder. As an investor, do you prefer the instant gratification of a higher dividend today or the exponential compounding of a fortress balance sheet tomorrow?